Hi, this is Matt at Vault Insurance and Investments. I hope that you're doing well. I just wanted to send you a quick video just to kind of reiterate a few things that we've said previously, but to summarize things in one quick email to give you more of an overview of the markets as opposed to what we see daily in the news, which is very focused on today. I hope you find this video helpful. If you have any questions, please reach out. Thank you. On your screen, you'll see the Callan periodic table of investment returns from 2001 to 2020. And I'll just go pick a 2003 range to 2008. 2003, emerging markets was up 55%. In 2005, emerging markets was up 34, and then 39 in 2007. So you can imagine wanting to get in on that. So for that person that jumped in emerging markets in the middle of '07, you're up a little by the end of '07, but I just want to point out, where would you be in '08? You know, in '08 it was down 53.33%. That's a big drop. And you can imagine if that was you, you'd feel like maybe you made a mistake or that was a bad investment. And potentially, you know, being halfway through that, selling out. But look again in '09. In '09, it was up 78%. But then, of course, and you see, the whole purpose of this chart is just to show how a diversified portfolio is key for a long-term strategy, because there is no one sector that is the best performing year in, year out. You want a balanced portfolio. That is what you want. So same thing, you can look at real estate. Real estate was great in '04 and '06. People jumping into real estate. And then, of course, '07 is down 7%. '08, it's down 48%. But did you sell your house? Most likely not. You held on to it. And if you did, then as we know clearly, you know, you've done well. And it's the same with stock. And that's really what I wanted to point out in this chart. We do want to stay invested. Just because one sector is down doesn't mean you throw it out or you sell it. If anything, it's a good time to buy. You know, many stocks are in a value position at this point, and that is a good time to buy. All right, this is just a study put up by BlackRock. I know Dalbar also did a study years ago on this, just talking about our emotions and how it affects us from day to day. So back in '06, we're getting into real estate or emerging markets. We're feeling encouraged, confident, thrilled, euphoric even, right? I mean, the market was up 50%. Things are going to be great. And this is when many people tend to jump in, right? We're jumping in here. But then, of course, you know, that sector, you know, goes down. And we're surprised at first, nervous, we're worried. And then at some point we get panic stricken. And this is where statistically people start to sell, right? So they tend to buy, they're getting on the ride here, and it's a roller coaster of a ride, and we're selling down here. And obviously we know that's not a good way to have a portfolio that maximizes your gains. This is doing the opposite of that, as the next slide will show. But I just want to point out, you know, on the previous slide, again, a diversified portfolio, just because you have a sector that was way down does not mean that that sector is bad and we got to get rid of it and it was horrible. No, it just means that that sector was down. But again, a key part to a diversified portfolio is having an investment strategy that's well diversified. On the screen, you'll see that the average rate of return for the S&P 500 between 1993 and 2021 was 10.7%. For the investor that followed the herd or did what we saw on the previous screen, where when we start to get too concerned, we sell out and we go to cash or other sectors, following the herd, averaged 5.5% over the same time frame. But I wanted to point out the yellow bar here, and that is going against the herd. And that is if we buy in when others are selling. It brings the average rate of return to 15% from 10.7 for those that just stay in, or 5.5 for those that adjust their allocations during down markets or change sectors. So something to consider. We don't know when the bottom is. I think there is clearly still more to come. That being said, I have people ask me often if they should lump sum in today or dollar cost average in. And there is a study that shows that lump summing in tends to be better, but that study was based on someone that was dollar cost averaging over their lifetime. We're not talking about that. What I'm talking about is cash in the sidelines today. How would I do it? I would definitely dollar cost average in. And that is just for your own mental sanity, because if you put 20 grand in today and that's your lump sum and then it drops 20% tomorrow, you're not going to feel too good about that. But if it is down and your dollar cost averaging in, you're almost glad in a sense that, well, now you know that you're buying that low next month or next quarter, however you're doing it. So I would definitely dollar cost average in over the next 6 to 12 months. And I'll plan to put out a couple other videos too. On that note, I know we've been doing more emails and more videos. And I know some people, they prefer just a call every now and then, and that's this. If you're getting too much, let me know, and I'll take you off the email list. That being said, I do plan on making a few more, and I think we'll talk about things that I would consider doing now. And in addition to that, I'm going to do a video talking about the first stock that I picked way back in the day, because I think it's a good lesson for today and what we're going through. Other than that, I hope you're doing well. I miss seeing you face to face. If you want to come in, that would be great. We are seeing people. I know a lot of people prefer Zoom, so whatever works for you works for me. And we'll talk to you soon.